As the automobile industry bears the brunt of a devastating market collapse, car prices will tumble by a staggering 50%. Yes, you hear that right. A remote dream for many of us, but a harsh reality for car manufacturers. So what could have triggered this sudden downfall of the industry? And how can you make the most of this golden opportunity to buy the car of your dreams without breaking the bank? So get ready to buckle up and brace yourself for the explosive insights coming your way. The looming wave of repossessions is predicted to resemble the 1920s and early 2010s auto loan crises, with analysts emphasizing the parallels. During the early stages of the auto industry in the 20s, car manufacturers and dealers were enticed to offer financial options that were easy to obtain, thus driving an impressive surge in car sales. However, the subsequent market crash spelled disaster for tons of borrowers who found it impossible to keep up with their monthly loan repayments. This phenomenon snowballed into a significant decline in car sales and ultimately culminated in an economic depression that lasted for an extended period. The lessons learned from this historic event compel us to brace for a similar outcome as we navigate these tumultuous times. The used car industry has experienced drastic price increases since June 2020, primarily due to a combination of factors. First, while attractive interest rates made it easier for consumers to obtain financing for their vehicle purchases, the production of new cars was severely constrained by shortages in semiconductor supplies. As a result, millions of drivers were forced to take out high-interest loans for used cars since new car inventory levels dropped to historic lows. Used car prices have skyrocketed to the point where they exceed the cost of purchasing a brand new vehicle. This phenomenon has resulted in an unprecedented used car bubble that has become even more pronounced than the new car bubble. These price fluctuations have created significant challenges for consumers regarding affordability and availability. With such a limited inventory of new cars and a high demand for used ones, many buyers have been paying exorbitant prices for pre-owned vehicles. In light of these developments, the future of the used car market remains uncertain. It is clear, however, that this shortage has profoundly impacted the auto industry and that consumers are navigating uncharted territory in car purchasing. In today's used car market, many dealerships struggle to stay afloat as they have paid an inflated price for the cars they now have in their inventory. As a result, they are offering unusually low prices for trade-ins to make up for the losses they are currently experiencing. Unfortunately, this trend has been observed over the past couple of years, leading to a severe financial crisis for many used car dealerships who find themselves upside down, meaning that the value of their cars is less than the price they originally paid. The automotive industry is in for a major shift as the prices of vehicles, specifically used cars, are poised to plummet after a long stretch of all-time highs spanning 2.5 years. This can be attributed to an influx of new supply, which flooded the market starting in 2020 and continued until 2022. Based on a combination of variable factors, including seasonality, mileage, and age, the wholesale prices of used cars are expected to experience a significant decline of up to 8.8%. According to recent data released by Kelley Blue Book, the average price of used cars sold in January 2023 was a staggering $27,156, which reflects a modest decrease of 1.5% compared to the previous month. The same report shows that the rates of price growth in new car transactions, while still high when viewed through history, appear to be slowing down. This is perhaps evident in the average transaction price reaching a record-breaking height of $49,507 in December before declining to a still impressive $47,681 in January. Please take a moment to hit that like and subscribe button if you're enjoying the video so far. The automotive industry is therefore facing a watershed moment, as the predicted trend reversal in used car prices marks a significant departure from the norm. According to recent research conducted by Moody's, the used car market is facing further decline due to weakened demand for domestic consumers. With the rising borrowing costs and inflation, households and businesses cannot make significant purchases, putting pressure on the already struggling used car industry. As a result, experts from JP Morgan predict that used car prices could fall by 20 to 25% in 2023, while new car prices could drop by up to 10% in the coming months. Moreover, concerns about the overall health of the auto loan industry have continued to escalate in recent months. Despite economic recovery from the pandemic, a significant number of Americans are still struggling to make their monthly auto loan payments. This has further deteriorated auto loan performance, with delinquency rates rising over the past 30 days. These trends paint a grim picture of the auto industry's future as consumers continue to face financial uncertainty and mounting debt. Amidst the current economic climate, new and used car loans are experiencing unprecedented changes. The latest data shows that the average interest paid over the life of a new car loan has skyrocketed to a record-breaking $8,436. Conversely, the average interest paid over the life of a used car loan has hit an all-time high of $1,204. However, as interest rates shoot up and more semiconductors become available, the supply of used cars is increasing. These factors have resulted in a dramatic 8.8% drop in used car prices in the past month alone, marking the steepest monthly decline to date. The current trend can be attributed to several factors, including an excess inventory of used cars, a decrease in demand, and a shortage of semiconductors that caused a delay in new car production. Consequently, used car prices are downward, presenting a suitable time for buyers seeking bargain deals. The current state of the auto loan market is cause for significant concern, with delinquent loans reaching an unprecedented level not seen since the global financial crisis approximately 15 years ago. The latest data from Cox Automotive presents startling facts about the rapidly declining health of the auto loan market. According to their report, loans that are delinquent by more than 2 months have surged by 5.3% and ballooned by 26.7% compared to last year. These impressive numbers have sent shockwaves through the financial industry, with loan delinquencies and defaults being identified as significant contributors to this trend. For example, in a recent earnings call, Wells Fargo, one of America's largest lenders, reported a higher loss ratio from auto loans than just a month ago. Even more alarming, Ally Financial, the top car lender in the nation, experienced 4 times as many charge-offs in the third quarter, precipitating a devastating 50% drop in the company's stock. The outlook for the auto loan market is undeniably bleak, with several indicators pointing towards further deterioration. Moreover, there is no doubt that these alarming trends will have far-reaching implications for the wider financial sector, placing pressure on lenders and investors alike to consider the far-reaching impact of the crisis. According to industry experts, the market for secondhand vehicles is bouncing back and approaching pre-pandemic levels. However, this resurgence in value has resulted in a sharp decline in used car prices. This unfortunate trend has rendered countless consumers who had purchased vehicles in the past 2 years financially vulnerable. As a result of the disparity between the value of a vehicle and what the consumer owes on the loan, many are left in a state of being underwater, where the car is worth less than the balance remaining on the loan. This precarious position can potentially spark yet another car industry crisis with devastating consequences. For example, a buyer who purchased a vehicle at the peak of the market bubble and is now underwater may find themselves in a difficult position. Should they attempt to trade in their car for a new one, dealers may demand a substantial sum of money to cover the difference between the loan amount and the car's value. For most consumers, this expense is simply unaffordable. These factors paint a worrying and unstable picture for the car industry's future and those who rely on it. It seems likely that significant changes will need to be made to prevent a full-blown crisis from occurring, which could have disastrous consequences for individuals and the wider economy. As per the observations by financial analyst Adamaya, the current state of the automobile industry is in a precarious situation, leaving all concerned parties, including dealers, consumers, and lenders, in a bind. The inability of the dealer to sell a car and the consumer's inability to buy a vehicle, combined with the lender's failure to provide financing, has left the industry in a lurch. This has prompted consumers to resort to a potentially dangerous practice of opting for a car despite having an existing auto loan with another bank. This is an incredibly risky maneuver, as such consumers are highly likely to default on the loan, leading to the repossession of the car in question. Furthermore, with lending options limited, dealers have been forced to put cars on the road, leading to a surge in repossessions in the used car market. As such, The industry is suffering from a major crisis, which is unlikely to abate anytime soon, making it a challenging situation for all involved parties. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.